Hello everyone and welcome back to another video series. Now I haven't uploaded in quite some time and frankly I really just did not have the time. I had a lot on my plate and so I was quite busy with a lot of commitments that I really just had to get done with, and I feel like now I might have some time to make a few videos. So I figured why not make some kind of a cool little series for you guys. Uh, Now the thing is, I before I actually start the video, I wanted to address some things which I have, I mean, outlined in my other like past video that I probably might not upload the subsequent videos of this series often, or I mean within the month. Like if I'm uploading this video in March, I might upload the next video in maybe May or June, but I mean, I'm pretty sure it will come up. So yeah, I just wanted to really say that because the point is I'm pretty busy nowadays, and I really have to honor those commitments, and so I just don't have the time to actually code or really make videos because I usually spend most of my free time trying to actually learn stuff myself rather than teach it to anyone. So yeah. So I'm sorry for not uploading for quite a while. However, I hope that you'll enjoy this video because I've actually spent quite some time researching about the contents of this video. So I hope you'll like it. Alright, so now let's get on with the actual video. So in this video, my goal is to construct a cool little portfolio optimization program. Now our goal will be to create a method, like a actual like a mathematical method which you can use to construct a minimum variance or a minimum risk portfolio for two stocks. Now, this has actually been taken, the math for this video has actually been inspired from another video, and I'll have it linked in the description down below where a person named Mike, I don't know the full name actually, let me just tell you the full name, Mike Debkovsky, Mike Debkovsky figures out how to do this, and it's a great YouTube channel, and you should absolutely check it out. They have this entire video series on a lot of different areas of mathematics which you can check out, and it does it really intuitively, and even though it doesn't use any fancy animations, it's like you just understand what he's trying to say. So definitely a channel that you should check out. So without further ado, let's just head right into it. And frankly, we are not really going to be using any very uh, hard to understand or very mathematical concepts. We are going to be using some, I mean, relatively basic concepts over here. And that's kind of the beauty of this, is that it's not that hard. It's actually kind of easy to understand. Alright, so I'm just gonna share my iPad screen with you guys really quick and we can actually get started. Alright, alright, so our objective. So I'll first write down, okay, I'm gonna do it in a different color. So I'm gonna do it in orange. Objective, minimum risk portfolio with two stocks. So that is our objective for this video. Now, before we start, I just want to write down the data that we already have. So we have some stock 1, which we have in quantity weight 1, and then we have some stock 2, and you know what, I'm gonna alright, stock 2 that I have in some quantity weight 2. Now there are a few conditions that these weights have to follow. Is that the sum of weight 1 and weight 2 should be equal to 1. So these are like gonna be like 0.5 and like 0.5, or like 0.3 and 0.7, or something like that, but I think you get the idea. So yeah, and that's pretty much all of it. All right, so kind of the expectation or the mean for the portfolio will look something like this. So the mean for the P, I'm gonna refer the the portfolio as P in this video, and this you can just get by the property of the mean. It's just going to be ES1 plus W2 ES2. So this is just the property of the mean. Means work this way, is that if you multiply all the elements of a mean or all the data of the mean by a certain constant, then the mean will also be multiplied by that certain constant. So basically, if you have some mu initial and you multiply it by some constant lambda, then your final mu will also be multiplied by that lambda constant. Or basically, if your basically what I mean is, like, if your sum of x is multiplied by the constant, then your mean will also be multiplied by a constant. And the reason why that happens is because of this. So if you write down the equation of a mean, let me actually do it for you so you can kind of get a good intuition as to why something is happening. This is the equation for population mean. Now let's say I am multiplying each value of my xi by some kind of a constant. Now since it's a constant, we don't need to write it down in the sum sign. We can just write it down outside the sum sign. So the mu new the new mean will just be some lambda over n, some I equals 1 and xi, which means that is going to be equal to lambda times the old mean. So this is the property that we are simply using here. So that's basically the property that we are using. Now the variance, which is just the square of the standard deviation, also has a property that is similar. Now I'm not going to sit here and derive that, but I'm just going to list it out so you can kind of check that out and you can check that out for yourself. It's actually not too hard to derive, so I will kind of leave that as an exercise for you guys. So yeah, plus W1, not W1, oops, W2 variance of S2 plus 2W1 W2 covariance of S1 comma S1 comma S2. So this is the equation for the variance and the equation for the expectation value of this particular portfolio. Now here's the thing, we are trying to minimize the risk. Now if you don't know, then the variance of a particular portfolio is its measure of the risk. So effectively we're trying to minimize the variance. So we are effectively, what we're trying to do is we're trying to come up with some weights that can minimize the risk or the variance, the portfolio variance that you get when you invest in these stocks. So the way we're going to do this is, first of all, we do a kind of a algebraic manipulation. Now we know that W1 plus W2 is equals to 1. We know that, right? So if we just assume W1 to be S, so we can, and now since I'm going to assume W1 to be T, actually not T, let's just assume it to be A. Alright, so W2 is equals to 1 minus A, right? It's nothing that's too insane. So now if I rewrite the equation for my portfolio variance, it's effectively just the same thing. It's just that we are going to write it down in terms of just W1, and which is obviously written in terms of an A. So I'm just gonna do A, 1 minus A, covariance S1, S2. Everything else pretty much remains the same. We are just switching out the W1 to be an A, and so we are getting some kind of an equation for W2 in terms of that A. So we have this variance. Now, if you remember back to your calculus classes, then I think you remember exactly how you find some kind of a point of maximum or point of minima for a function. Effectively, if you have some kind of a quadratic function, something like this. Now, I'm going to give you this example since I'm assuming that you kind of don't know how to do this. So, assume you have some kind of a function x squared. So, the function will look somewhat like this. Now if you want to figure out the point of minima for the function, what you do is you find out the derivative of that function. So you get that as 2x. Now if you want to find the point of minima for that function, you solve the derivative for 0. So equate it to x, the y equals 0, and you get the value of x. So at x equals 0, your function reaches a minima. you can try this out for a few functions yourself and get some an intuition as to why this is the case. I won't go over this, but basically, since you are effectively just drawing a tangent, it's just saying that if you draw the tangent over here, you get that uh, minima. So I'm not gonna go into that right now since that's like an entire video on its own, but that's effectively what we are trying to do. So as you can see, we have pretty much worked out most of the math. All we have to do is just differentiate this. So we just differentiate with respect to the a that we wrote of the p. So we are effectively just differentiating the variance of the p with respect to a. So effectively we are just trying to differentiate this function. So that basically gives us, so now we are just going to do some pretty standard differentiation. So that's going to give us 2a variance of s1 plus, alright, now I am kind of rusty with my differentiation skills, but so that gives us 2, 1 minus a, and the minus a becomes a minus 1, so it actually becomes a minus 2 over here, variance s2 plus this is just a 2, and I mean I could open the bracket and do it. I think I'm going to do that. I'm going to write out one extra step because I want to avoid making a mistake. So I'm just going to write it down like 2a minus 2a squared covariance of s1 s2. I know I could have done it with like one less step, but it's better to write an extra step than to make a mistake. So I'm just gonna write that down. So we bring the 2 down, that gives us a minus 4a. So that just, we take the 2 out as a common, so that gives us a 1 minus 2a. Alright, so that's a 1 minus 2a. So we take the 2 out, 1 minus 2a. Covariance s1 s2. Alright, perfect. So the now we just have to equate this to 0. So we know that for minima we need to equate this to 0 for minima. So basically we are trying to say that 2a variance of s1 minus 2 1 minus a variance of s2 plus 2 times 1 minus 2a covariance of s1 comma s2 should be equal to 0. And I know that I've written some math over here. I know you might be thinking that, damn, this stuff is looking a bit complicated, but frankly it is not that hard. You can see that, I mean, yeah, sure, we are using some calculus, some partial differentiation, we are using some statistics and probability rules, but you can see that it is doable. It's a bit tedious, but it is doable. And this effectively is the equation to find out the answer to this question. Now, we could obviously rearrange this and write it out in a bit of a nicer way. So I think I'm going to do that. So we could just quickly go ahead and write it out like that. So I'm going to do that. Alright. How could we write it out a bit nicely? Alright, so pretty much this is up to your reference, because this is the answer. What we have here, it's the actual answer, and if you plug this into your computer using a program, you will get an actual answer for the question that we're trying to do. But I mean, look, a lot of the times it's better if you have some kind of a simpler to understand solution in computer science, because it allows you to actually make your code a bit more readable. Like, I could plug this in, but it would be absolutely unreadable. Now one thing we can do is cancel off the 2's. So yeah, that's all we can cancel off. So we get a variance of s1 is equals to 1 minus a variance of s2 minus 1 minus 2a covariance of s1 comma s2. And so now I mean, I wish I could do some taking commons or something like that, but I think this is pretty much it. I'm gonna check out the video for 1 second, and I'm gonna see if I got my answer correct, because I want to make sure that I did get that correct. Yeah, I do seem to have gotten the answer correct. However, for the manipulation portion of the answer, he has done some smart stuff. Like, one second, let me see if I can get this manipulation. So, I've maybe changed up some of the conventions used in the video, and you know what? Frankly, I'm gonna go with this right now. Uh, I mean, yeah, sure, he has done some smart stuff in order to manipulate this better and actually land on a better solution. But I am not perfect, so I'm just gonna run with this. So this is effectively what we have. Alright, so now let's actually get started and let's actually construct a portfolio. Perfect. So I'm gonna open up my terminal window. Just a second, let me just have a sip of water. Actually, you know what? I'm not gonna do this in a terminal window. I'm just gonna end up doing this in a Google Collaboratory. Basically, because I don't know, something's weird with my Jupyter lab right now, and I don't know, it's just not that great. So I'm just gonna do it in a Google Colab real quick. And you can use Google Colabs yourself, and you generally want to use this if you have like a slow computer, basically because you can use like GPU stuff. However, if you have a really good computer with like a 3090 or like some 4090, something like that, then you obviously don't want to use this because it's obviously going to be slow. But I mean, I'm pretty sure the vast majority of my audience don't have that kind of a machine, I'm assuming. So minimum variance portfolio with 2 stocks. Alright, we're gonna need a couple of modules. So we're gonna need numpy as np, and we import Yahoo Finance dot stock info as si. I don't think I'll need anything other than this, so I'm just gonna go with this. I just hope I've connected to the GPU runtime before I ran this. God damn it, I haven't. Yeah, alright, I'm gonna have to rerun this. So I'm gonna reconnect to my runtime. You wanna make sure that you do this before you actually run all the code cells. Because if you change your runtime, you need to rerun all the code cells. So make sure you do that first. I just hope I have the. I don't think I can do that. Okay, I don't think I've installed that. Alright, so I can just search for that. Yahoo Fin Pipe. So, okay, I think this is the one that I'm wanting to use. Yep, this is the one. Alright, so I'm just gonna go ahead and insert a code block. Put that over here, and we can simply just type in a command pick3. Actually, I can just paste this pick3, and I can just go ahead and run this. Perfect. And it should go ahead and install this entire thing for me, and blah blah blah. Should do everything pretty quickly. There we go. Alright, and I'll have to check out their homepage because I don't remember exactly how this module works. So yeah, stock info. Yeah, this is the one. From Yahoo underscore Fin. I think it should run now. Yep, there we go. And now I think I do remember how the stuff works. Alright, so now let's select our stocks. So for now, let's select our stocks, and let's just select Google and Microsoft. Alright, so now let's I actually kind of want to choose some kind of a riskier stock, and we'll do that maybe later in the video. For now, let's just choose 2 stocks that aren't too risky. These two are negatively correlated as far as I know in the recent past, given the entire Microsoft Google kind of feud that has been going on. But yeah, alright, so stock. Actually, I think I'll need both of this data in separate lists. separate list. So I'm gonna go stocks. So Google data will just be si dot get data for Google, and I'm just gonna run this one thing and just see if I can get something. So let's see what we get. All right, okay, so as far as I can see, it's a pandas data frame, if I'm correct, and I think I am. Yep, it is a pandas data frame. So I'm just gonna go ahead and import pandas too, because we might just have to use it. So import pandas as PD, and so now I think we can actually manipulate pandas data frames. All right, so I'm also gonna load in Microsoft data. So Microsoft data is si.get data msft. So that should give us the Microsoft data as well. That's perfect. All right, so now we have the Google and the Microsoft data. Now first off, what we want to do is we want to set some kind of a days period. So I'm going to set it as 252 days. And now what I want to do is I actually just want to get the close prices. So close Google close prices is equals to Google data close dot to list. So that should give us like the list of the close prices for Google and MSFT. Microsoft. I'm just gonna copy that because I'm probably not gonna spell that correctly. Alright. And I'm gonna go ahead and further just input this. I'm gonna do len of yeah, I'm just gonna do len of Google data minus days colon, and for this I'll just do len of Microsoft data minus days colon this. Effectively this should give us 252 data points. You can check out how this works by yourself. It's a little bit of an exercise for you guys if you guys want to check it out. Alright, there we go, 252. Now obviously if you want, you could plot this out, get some kind of an information, what's happening, blah blah blah. I don't really care about that. This is not much of an analysis video. This is more of a portfolio optimization video. So now I'm gonna go Google weight, comma MSFT weight. Obviously I'm gonna actually no, I don't want to do that. So I'm gonna do Google variance. So actually, so I'm gonna have to convert this to, actually yeah, that's a bit of an issue. I should have kept these as numpy arrays. So I'm gonna have to convert these to a numpy format now. I should have just done it previously, but that's alright. As far as it works, it's kind of okay. So now I'm just gonna kind of get an idea of the shape of the data. Yeah, that's alright. Okay, so now what I need to do is I need to get some I need to get the variance for this. So Google variance variance is equals to np dot var, and I'm pretty sure where np dot var is a action function. Oops, what's happening? MSFT, and we can just use MSFT close prices, and I think this should be good enough. Yep. So if I get Google variance, MSFT variance, and I can just print these out, and perfect, I get these variances. That's alright, that's perfect. And the reason why Microsoft variance is too high is because, you know what, I'm going to plot Microsoft so that I can show you why that's the case. So if I just plot this out, you should get an idea that Microsoft has just boomed over the past year. You can see that. It's just boomed. Like, no joke, it has increased tremendously, and It's just insane as to how much it has risen. Also, for those people who are not really understanding as to why I'm choosing 252 days as a measure, the reason is very simple. It's just that I know that a year has 365 days, but also keep in mind that a year has weekends and stock markets aren't open on weekends. So if you want to get 1 year, and I'm not saying 1 year of like financially open market days, I'm just talking 1 year of normal days, then you don't want to choose 365 because that's more like probably a year and a half or somewhere around along those lines. So don't choose 365, choose 252. Yeah, 252 is like a reasonable estimate of that. So yeah, all right, perfect. So we have the Google variants and we have the Microsoft variants. Now immediately from the graph that I showed you, you could spot a problem with the method that we're trying to use. You could see that the Microsoft share price has actually risen quite a bit. Now, while you could technically classify that as risk, that is not downside risk, that's upside risk. And you actually can't really call it risk because it's not really the technically like it's not like in reality you can't really say that that's the correct word for it. It's more like reward. And you'll see that after we actually create this model that we have developed, you'll see that the output that we get, we'll see that it will be weighting Google over Microsoft. And the reason why the model does that is because we are just looking at the variance. We are not looking at downside and upside variance separately. Now, while sometimes such a thing can be useful in cases wherein, look, I could say that Microsoft has risen so much, and that's a great thing. But I could also counter my argument by saying that if this particular stock has a tendency to rise this much, then it also does have a tendency to fall by a great amount. So, is it a good stock and should I weight it a lot in my portfolio? Now, if I'm someone who is really risk adverse, then I might probably look the other way and I might not invest. And but if I mean I like to take at least some risk, and frankly with Microsoft all of us knows that there isn't a lot of risk because given the way they have you know worked with the entire AI sector nowadays, we can see that Microsoft is a company that certainly knows what it is doing in the long run, and so obviously it would be a very good bet to invest in them. However, our model will not say so. So you can see that there are problems with our model and there are pretty big gaps. And so you obviously shouldn't use this as financial advice and you shouldn't base your investments based on just this singular model. Because believe me, portfolio optimization and just portfolio management, it's a degree in its own. It's literally risk management and stuff like this. It's a degree in its own. And so what we are doing over here, it's not even the bare minimum of what is actually there in the field. So trying to base your investments on something as basic as this, on a model that is as basic as this, would be unwise to say the least. So please don't do that. This is just so that you can get a good and decent introduction into the field of portfolio optimization that is both mathematical and programmatic, so you know how to develop on both the ends, and you can be well rounded in this field. However, again, gonna say that again, don't use this as an investing tool. Or I mean, whatever you do it on your own risk. Don't pass blame along, because I mean, if you can make money, do it, but you're probably not gonna make money. So yeah, just there's the pretty long and drawn out disclaimer that don't. All right, pretty much. So now we need to get the covariance. So we can pretty much get the covariance, and you know what? I should have just done it all in one go. So np.cov, and we just do go close prices and MSFT close prices. So we can just print out the covariance, and perfect. Okay, why on earth do I have a damn matrix? Okay, I'm just gonna see how this works. Get covariance between two values Python. I don't want a matrix, I just want the covariance by like covariance between like two values. Calculate the, okay, so you just get the 0 and the 1. Okay, cool. I just hope that it's correct, because otherwise you're gonna get wonky results. Alright, I'm just gonna do this to help with it. Alright, this is the covariance. Perfect. Let's run with this. Alright, now let's move on. So now all we really need to do is just implement the formula. Def min variance portfolio. Now I'm gonna do this in a method. The reason why I'm gonna do this is, you know what, I'm gonna rename this to, yeah. Alright, the reason why I'm doing this is in a method is so that you can kind of make it a bit more reproducible. Obviously, you know what, actually, to hell with it, I'm not gonna do this in the method, I'm just gonna do this the way it is. Alright, so how should we actually kind of start with this? Alright, okay, I think, okay, look, really all we need to do is we need to solve that particular equation, but for that we need to substitute for a, and okay, I'm just gonna check out the video. So basically this guy, he did some smart manipulations. I'm gonna check out exactly the manipulations that the guy did, and if I can kind of replicate those specific manipulations. Oh, okay. So he basically did something very similar to what we did. He just did it. He just made one slight adjustment to the method, and I think that was a better adjustment that I should have probably seen. But I mean, as long as I get the answer, who cares? Alright, let's see. Okay, so he takes the. Alright, so what the guy has done is he has taken the S as common. Alright, so basically he has taken A to be the common thing, and not the variances and the covariances, and not the two. So a slightly different method, but you can see that it's the same thing in a way. So I'm just gonna write it down. So that tells us that it's 2 times the variance of S1. I'm just gonna write down the revised equation, and I will share the screen so you guys can check that out for yourself. And don't you worry, I'll also kind of probably try to I'll have the GitHub repository for this. I will have the uh, notebook where I'm solving all, like I'll have a PDF to that, so you guys can check that out. Because I mean, I think it might be helpful if you had some kind of a documentation for this. So yeah, so I'm just gonna quickly write it down. I'm just gonna quickly do the substitution myself, and then I'm just gonna share the screen to variance one. Alright, and then he just took A to be the common, so he just got to variance S1 minus 2 covariance S1 S2. Now if you were to put this in a calculator, you could obviously, you wouldn't really have to care about doing all this, but we ain't so lucky. Alright, there we go. Okay, I'm just gonna quickly share my screen so you guys can get a look for yourself and just understand exactly what is happening. Alright, I'm just gonna quickly take a look and just verify if what I'm doing is correct. Alright, yeah, I think I got it correct. I think I did. Yeah, it's correct. Well, at least I got the correct equation. Alright, so okay, why? Yeah, there we go. So this is the way that they have gone and done it. All the he has done is he just expanded this brackets and took a as the common, and then he just wrote the entire equation in terms of a. So that was really the only difference in their method and ours. Other than that, it's pretty much just the same stuff. So yeah, this is the only difference in the method. And yeah, you could see that it's literally the same stuff otherwise. So yeah, all right, so now we at least have an equation to work with, so we can now get the value of a. So a, which is going to be our Google weight, is just going to be the all right, so I'm going to write the numerator and denominator like quite distinctly. Usually whenever you're writing out so large equations, it's always good to do stuff like this: variance minus covariance divided by covariance. Covariance. Now that I'm writing it, it's actually not that large. Plus MSFT variance minus 2 times covariance. And so this is just going to be our W1, and then W2 is just going to be equal to 1 minus W1. So now if I just go ahead and get W1 and W2, I get the answer, which it does satisfy a certain condition, but it also doesn't satisfy another one more condition that we don't have. Okay, so you can see the problem over here. The one problem that we are having right now is the fact that you can see that W1 is coming out to be a like a 1.32, and it's not and it's not exactly, I would say, it doesn't actually fall within the bounds that we have, which is a bit of a problem because yeah, I mean, it technically should have fell within those particular bounds. So I kind of, all right, so let's, like, what if we maybe choose some other stocks? So let's choose something like SPY. Okay, well, one thing I can see, if I choose like now this actually gives you some kind of an actual result. So effectively, I think in those particular companies like Google and Microsoft, since we haven't accounted for certain things like the change, like basically what was happening was this, that uh, the difference between the variance and the covariance was so large that basically the covariance was such a large value that actually, like, no wait, the way basically the difference and overall just this entire value, it was just getting too crazy, and so I'm guessing that's why uh, our entire model was kind of getting freaked out. Because yeah, so basically I think that is pretty much the reason as to why our model was getting so freaked out with this stuff. And I mean, you can see that with Tesla and SPY it does work. So I think for a base you really do need an index fund to do the trick over here. So like, I think if I compare SPY and Microsoft, alright, so effectively what's happening is I'm getting weight 1 to be like 1.9 or big value, which really shouldn't be the case. Right, you know what, I have the only place that I could kind of have screwed up is the covariance function. Yeah, that website isn't the best. Alright, So effectively, I think the only place that I'm kind of screwing up right now is just the variance and the covariance part of this entire thing. And while I don't think I've messed up anything, uh, Google and Microsoft. Oh, so this is where I screwed up. See, this is where I screwed up. It's supposed to be MSFT variance. I was just reviewing my calculation and I saw the mistake. That didn't make that much of a difference. Wait a minute. Alright. So the covariance is 1110. The Microsoft variance is this. If I add Google and Microsoft variance, I get something. Then I multiply that by, and then I subtract it by 2. I'm literally following the exact same equation as mentioned in the video itself. And so it's kind of weird as to why I'm not getting the answer. But I mean, for most companies, I think it should work. If I just do Tesla and SPY again, I get this. Effectively, what's happening is that the covariance value is too large. I don't now. I know this is probably gonna screw it up, but what if I do this? If I get the correlation, then that might effectively work. What? It's literally throwing me an error. Alright, so if I do this now, cool. So now, okay, now wait. So if I do Google and MSFT now, the way it was intended to be. Yeah, alright. Okay, so I think we needed, we needed to get the correlation coefficient, not the covariance as in that. So basically we need to get that basically we need to get that scaled down, because basically we were getting, since the share prices were different and like you can't really put them on the same scale, we were getting like messed up values. Now since this basically brings them from 0 to 1, you could say that it's kind of scaled between a feature range, and that's why we are getting correct values now. So if I sum W1 plus W2, I should effectively get 1 every single time, and that's pretty cool, isn't it? So there we go. Took some time. So it's the correlation between the two stocks. I don't know, even like, because I was kind of confused as to why we would just calculate like the covariance, because that would kind of create larger answers, but whatever. So there we go. So this is the math, this is the theory, and you can see that we have all of it in this one video. Now I know this video might be a bit technically dense, and it was certainly kind of long. Actually, how long was it? Yeah, it was long. All right, but I do think that this certainly is a very good learning experience, and certainly something that should allow you to develop in the field of just stock analysis and the basics of quantitative analysis of stocks. Now, I know that the mathematics might be intimidating to a few of you. However, I frankly don't find any way around it, and I just hope that you can reconcile with your relationship with mathematics or whatever you want to say. But you can see that the mathematics used over here is not that difficult. I mean, if you have paid attention to your high school level mathematics, at least the high school that I go to, you should pretty much be able to understand all of this math. So it's not that complicated. And I mean, you can also see that the final equation that we arrived on, it was actually a pretty neat looking equation. It was like don't like I'm pretty sure all of you can agree with that. And so now, just before we end the video, I wanted to do this cool little thing. I wanted to use a very safe stock, SPY. It's actually not a stock; it's an index fund, but you can get my idea. And I'm gonna compare that to an extreme, like some kind of a very dynamic kind of a stock. So I want to think of a good one, and I think I know one. Now this is actually a penny stock, and I did manage to find it before this video, and let me just show you exactly how insane this stock is. So in the past year, it did grow by 97%, and why that might seem non-penny stocky, you can see that just how dynamic the growth was in the past like a few days. It like grew like 100%, something around that value in like 1 or 2 days. It was insane. So I want to use this because it's gonna be fun to have a stock that is so insanely volatile. I don't know if I'll even be able to get the data. Apparently I can. That's cool. I can just imagine the way. Yeah, just look at that variance. Alright. Damn. Alright, there we go. So you can see everything is working. And yeah, I don't even think I got the correct share over here. But usually you can see that for extremely volatile stocks, it kind of gets messed up. You can check out SPY, Tesla, you can check any stocks you want. You can play around with this now, it's up to you. And frankly, again, you can do whatever you want. And it's yeah, and you can get like cool little results and some kind of portfolio weights for yourself. Alright, so that's pretty much it for this video, and I hope you enjoyed it and got a lot to learn from it. Again, before I end the video, I just wanted to end with the disclaimer that this is not investing advice. Whatever weightings I've gotten over here should be taken not even with a grain of salt, even lesser than that. Believe me, the last thing you should do is just watch one YouTube video and get some cool looking results and invest like all of your money into it based on that single thing. Investment and managing investments is a pretty difficult task to say the least, and it should be done using a lot of caution, a lot of work, and certainly not just with 40 or 50 minutes worth of information condensed in one video. If you want to learn more about investing, I definitely recommend you check out Mike the Mathematician's channel. He has like a 25 video series dedicated to advanced financial concepts that you should definitely check out. If you obviously want to learn more about it, you obviously should go through actual trades done through, you could actually go through like read some books, actually do some paper trading by yourself, analyze financial statements, read some books on like quantitative finance and quantitative based strategies.